I don't know if you can get your heads around this. And if you're not a crypto investor, I simply don't understand why, when you've got the best performing asset class of all time, the fastest adoption of any technology in all time outside of AI, the largest generation of and fastest generation of wealth in the shortest period of time, why you'd not be involved? I think this space is going from 2.5 trillion to maybe 12 trillion this cycle to 100 trillion by, let's say, 2032. That'd be the largest, fastest wealth accumulation of all time.
With crypto currently outperforming every asset class in history, Real Vision CEO Raoul Pal expresses extreme bullishness at its future performance, encouraging everyone to get involved before prices rise up dramatically. Pal forecasts a substantial growth trajectory for the cryptocurrency market, envisioning its value potentially surging from $2.5 trillion to $12 trillion in the current cycle, and reaching an astonishing $100 trillion by 2032. As for Bitcoin, Pal predicts that it will reach at least $200,000 before this cycle ends. Let us now view clips of Raoul Pal as he shares his latest bullish predictions and insights. While watching, please give this video a thumbs up, subscribe to the channel, and enable post notifications for more similar content. Make sure to stay until the end of the video to also hear Pal's expert insights on macro cycle. We hope you enjoy it.
Annualized return of Bitcoin is 140% a year since 2012. You can own any VC fund, you can have any other asset class. Nothing comes fucking close. 20 million % returns since 2012. 20 million %. Since I started Real Vision, Bitcoin is 450,000% returns, and we started talking about it. But ETH came a cycle later, a couple of cycles later actually. Well, ETH is about 160 something percent, 165% returns annualized. Been around less. Solana, 200% returns annualized because it's been around less, early on the network effect. I don't know if you can get your heads around this. And if you're not a crypto investor, I simply don't understand why, when you've got the best performing asset class of all time, the fastest adoption of any technology in all time outside of AI, the largest generation of and fastest generation of wealth in the shortest period of time, why you'd not be involved? It's just bananas to me. It's a scam. All you're doing is helping yourself disappoint your future self. Right? An asset is future deferred consumption later. And you want your assets to be worth as much as possible because you're taking risk with that money by locking it up. So therefore you should be compensated for that risk. Your future self will go, well done, Raoul. 10 years ago, 15 years ago, you bought this stupid thing called Bitcoin and it's now up 20 million %. Thank you, that's great. I can go and buy a house or go on a world cruise or buy a mega yacht. Oh, I bought gold mining stocks. They've gone nowhere for 40 years, but Raoul, my purchasing power has gone down. What the fuck? What was your earlier self thinking, Raoul, moron? No, it's nothing against gold. Gold does absolutely fine in debasement, just doesn't make you rich. It's a great wealth preservation tool. So anyway, that's what I got to, and it's not because I'm like this singular focus, Bitcoin or blockchain or crypto is everything. It's because it is everything when it comes to what I'm trying to do for myself, which is deliver my vision to my future self of what I would like. And technology does that pretty well too. So anyway, I think this space is going from 2.5 trillion to maybe 12 trillion this cycle to 100 trillion by, let's say, 2032. That'd be the largest, fastest wealth accumulation of all time. I'm not going to talk about my NFT thesis, but it's built on that thesis, that there is going to be $1 trillion of new wealth created, which would be the largest amount of new wealth created in all history. That's, by the way, twice the size of the 100-year accumulation of wealth of the S&P 500, just to get your heads around what it is. Maybe I'm wrong. Maybe I'm wrong by 50%. So 50 trillion. So it's the same as the S&P over 100 years. 25 trillion, half the amount the entire US economy had generated in equities over the last 100 years. You know, it's bananas. So given that all assets are driven by debasement, everything is basically driven by the business cycle, and everything is correlated. Some things lead, crypto and technology lead. As the business cycle bottoms, so ISM comes across 50, commodities and cyclical plays come into play. There are some lagged things that come behind, real estate and stuff. But anyway, business cycle rules it all. Everything's highly correlated. It's all driven by the everything code. So the dirty secret is this is the easiest fucking game in the world. You just divide all the asset prices by each other, look for the best performing asset. So that's what I did, and that's what I uncovered, and that's what changed everything about me. As you know, I've been involved in crypto since 2012, but I really started to realize that if I divide S&P by crypto, it's down 99.98%. If I divide gold by Bitcoin, down 99.99%. If I divide oil stocks, if I divide emerging markets, if I divide world equities, 99.9%. They're all down since 2012 versus Bitcoin. And technology, the secular bull market that's made everybody a fortune, down 99.93%. So everything goes down 99.9% over time versus crypto. Actually, when you look at it, crypto is the best performing asset in the world, 3 out of 4 years. Fourth year, it's the worst performing asset. Then it's the best performing for 3 years. Then it's the worst performing. This keeps going on. Bitcoin, even with 3 or 4, 80% drawdowns-ish, 75, whatever the average is, still has done about 140% a year returns.
Before we proceed with more of Raoul Pal's expert analyses, here is another piece of latest news you might also want to know about. The recent Deutsche Bank survey of over 3,600 consumers indicates a shift in sentiment towards cryptocurrencies, with over half of respondents now viewing them as an important asset class and method of payment, compared to less than 40% in a previous survey. Additionally, 10% of respondents expect the price of Bitcoin to exceed $75,000 by year-end. The survey also highlights decreasing skepticism towards Bitcoin, with 40% of respondents confident in its future success. Factors such as the upcoming Bitcoin halving, regulatory developments, and expectations of SEC approval for spot Ethereum ETFs are cited as potential drivers for Bitcoin's price growth. Various experts and institutions, including Coinbase, Skybridge Capital, LMAX, and Bitwise, anticipate significant upside potential for Bitcoin, with some predicting 6-digit prices in the future. Let us now return to Raoul Pal, as he gives us a rundown of where we are in the macro cycle and how it's going to play out.
Okay, macro summer, crypto summer. We're at the phase where the Bitcoin halving is happening, the election cycle where they give out free candy to the kids, stimulus, and we generally get, well, we've got the central bank who want to cut rates, even though inflation's not playing that game. We'll talk a bit about that in a sec. And then we've got global stimulus cycle from the weekly global liquidity index, which has been rising. So this is the part where liquidity starts going up significantly. The Europeans are going to start cutting. We've already seen, I think, the Swiss cut. We're going to see a few nations cut. Latin America was first to hike, started cutting. Brazil. So we'll see the cutting cycle, global cutting cycle will pick up. We've got China with a very lackluster economy. In fact, it's a debt deflationary trap driven by an aging population and excess debt. We all know about those things because we're all living in one, whether we're living in Europe or living in the US or Japan. So they're going to stimulate more. The Japanese are pretending to raise rates, but they've still running kind of negative interest rate policies when you look at it in real terms. And we should see inflation continuing to slowly decline. Now it's been flatlining for a while, but many of you have seen me tweet out a chart of previous inflation cycles versus this one. It always has this flat bit, then it hooks down. If I look at the Trueflation index, the guys at Trueflation have this real-time inflation index with millions of prices. That thing is now at 1.78%. It's falling. I know nobody believes me. Either way, the Federal Reserve want to cut rates. Why? Because of the Everything Code. I've told you about the Everything Code. If you've not seen it before, please watch the YouTube videos on the Everything Code. The Everything Code basically suggests that they have to use liquidity to monetize the interest payments on the debt. we're coming into the teeth of the interest payments now, and we're paying for the interest for the debt we issued during the pandemic. So we got a lot of payments to do. The bond market's freaking out from this, obviously, because they're like, how can we pay for all of this stuff at 5.5% rates without issuing more and more and more debt? Gold market's breaking out on the back of this, and so it should be, because the answer is going to be they're going to have to use liquidity. Will they use quantitative easing? Probably not. Why? Because we all know the trick, and we know the name quantitative easing equals money printer goes brr. So what will they do? Well, they've been running down the reverse repo. That's okay. It doesn't matter what the format is, but they've been running down that, which means banks have been putting money into the market. Then they have been they're still doing quantitative tightening, but they're already talking about, well, at some point we need to stop that. Of course they do, because the reverse repo is almost empty. That runs the Fed out of opportunities at this point. Next part is, what do the Treasury do? Because the Fed is basically just helping the Treasury now. Well, the Treasury's been building up the Treasury General account. That's their bank account. And then what they will do is start running that down over the election, which is liquidity flushing into the system. We've got to get through, I think Mike Howell talks about this. We've got tax season, and often that takes money out of the money markets, and then it goes into the Treasury General account, then it gets drawn down. Some people think that's liquidity negative. I'm not entirely sure. But in the end, the Treasury General account will be like $1 trillion, and they'll inject that $1 trillion nicely back into our hands, and number go up.
What are your thoughts on Raoul Pal's bullish predictions for the cryptocurrency market? Share your thoughts in the comments section. If you found today's video informative and would like to receive more insights and updates on cryptocurrency and global finance, please consider liking the video, subscribing to our channel, and enabling post notifications. Be sure to stay tuned for our next episode, where we'll uncover more about the fascinating developments in the crypto space. Until then, keep questioning, keep exploring, and most importantly, keep investing wisely. Thank you for watching, and we look forward to seeing you in the next video.